Hi all, Ken Simpson with crystalbull.com with the stocks to watch for the week of October 6, 2019. The following presentation is for educational purposes only. Nothing you're about to see should be considered investment advice or a recommendation to buy or sell anything or to participate in any particular trading or investment strategy. Trading involves risk of loss and you assume all of that risk. This is not investment advice and may not be suitable to your situation. The charts you're about to see were created using MarketSmith, a registered trademark of MarketSmith Inc. It's been enhanced with a custom Chrome browser extension that we wrote. The extension is not available for distribution. MarketSmith will not give us permission, but you'll see some extra colors and so forth that are not available in MarketSmith. Please don't ask for a copy of the extension. And let's get started. We just have a few stocks to look at this week. So we'll start with the NASDAQ 100. As we like to do, we've overlaid a representation of the IBD Market Pulse. Here you'll see that the market pulse has been almost 180 degrees out of phase with this market. It's calling correction here with these double red arrows pretty much at the bottoms. That's not telling you that a correction has happened. It's telling you the correction just started. These double arrows, if you're in their ETF strategy, basically tells you to sell everything here at the bottom. It's been way out of phase. Buy it back. The green arrows are when it goes into confirmed uptrend. That's when they want you in the ETF strategy to buy your stocks back. The single red arrows are when they say an intermediate stage of uptrend under pressure, which they tell you to sell half of your stocks here. So you sold all your stocks here, you bought them back. You sold half here, you bought that half back. You sold that half again. So you can see their performance. This orange line represents a rough outline of what returns you would have seen if you follow their ETF strategy here and buying and selling the NASDAQ 100. They're currently uptrend under pressure, which means they're halfway invested. Okay, you can see this ETF strategy has not performed well. Not only has it not kept up with the market, this here on the left goes back to where it started at the same stage as the market. We've been tracking this for a longer period of time, but you can see it hasn't even avoided the drawdowns. So not only has it underperformed the market greatly, you haven't even stayed out of the drawdown periods. Not good. This has hurt a lot of people, as we predicted when we did our Market Pulse review a few years back. The purple line here is following the Crystal Bull trading indicator. The gray lines here are when we entered the market, and the pink lines are where we exited. We entered the market here. We exited here, we entered the market again and exited the next day, or re-entered the next day, we exited here, bought the stocks back, and so forth. We went, in this last IBD, went market in uptrend under pressure. The Crystal Bull timing model saw this as oversold and purchased. The market started to rebound. Of course, we had that crash day. And here on Friday, the Crystal Bull trading indicator just exited the market. Saw this as overbought and went to cash. So the Crystal Bull trading indicator, we'll take a look at that, is currently in cash. So not healthy here. You can see the market's been churning for a lot of the second quarter and still into the third and fourth quarters. So this has been a very difficult period for growth stock investors, as you can see in this chart, and we don't have clear sailing ahead either. So it's a time for caution. Well, let's take a look at the Crystal Bull indicators quickly, then we'll go through a few stocks to look at. So here's the trading indicator. You can see that the indicator has done a good job of picking up these dips. Okay, it saw this as oversold, and to go ahead and enter the market if you're not already in it. It saw this as overbought this period. This was troubling, and the indicator wanted you to exit. Okay, then it picked up this dip, then it picked up this dip, and it picked up this dip, as you can see. Then it picked up here, right here, market rebound, and then sold off, as we just saw, and it's picked up this dip. Now it's just saying this is overbought and exited. The trading indicator exited here, so it purchased here and exited here. Took a small loss through all that noise, but it is currently out of the market. Okay, something to be aware of. If we look at the macro indicator, you can see that the macro trend has been following. The macro indicator has done a pretty good job of preceding recessions. You can see how it's fallen, and it is getting weaker. You can see in an interest rate environment and sales and EPS growth and so forth. The macro picture is getting a little weaker. It's still not, in these periods of weakness, the market's still done well. So it's not telling you to sell everything here. It's just telling you to be cautious. It's the macro conditions are coming down. To be aware that may change. If this were to turn below zero here, be very troubling. The current trend has come back up. It's positive again. You can see that the trend was terrible through the 2008, the Great Recession, and a couple of times you can see here the trend turned negative. The trend indicator here, negative trend, as you can see in the chart. Turned negative here through this noise, and it's positive again. So that's okay. It's still showing that we have possibly a positive trend going forward. There is room for growth still, and room for stocks to grow, perhaps. But this is a trend following system. So it won't tell you that the trend is negative until it has already started to turn. So that's has a lag to it. It's not predicting the future. It's telling you the current trend. Okay. Now back to the charts. Let's take a look at what we've got here. We just got a few stocks to look at this week. All right. Most of these stocks are in bases, or they're failing, or many have formed double or perhaps head and shoulders, where they may even become short candidates here. So there's a lot of weak patterns. These stocks have been churning, and many of the high growth stocks have been dropping. We'll take a look at VEEV. Okay, VEEV, really nice uptrend here. These lines are for our sloping trends line, our basis for previous presentations, or what we looked at in the past, and had a real nice run up, and it's basing again. This is a double bottom base. And the green area we've put in here, now MarketSmith's not picking this up as a double bottom base, but it's a pretty nice looking double bottom base, especially in this current period of choppy stocks. This green area is a shakeout plus 5 to 10%, which would be viable from a double bottom base. Okay, we're not doing anything. If this thing wants to roll over and keep going, we don't care. Let it go. We're not in this stock. We're not recommending anyone buy it, but we're saying that if it were to get up into this area, and we've got our alert set, take a look then. The volume has been really picking up here. 41% earnings growth, 27% sales growth. EPS is expected to keep going nicely. It's coming down to 15%. Now I want to talk. We'll stop here for a second on this EPS. Now when the Trump tax cuts went in for 2018, and of course corporations have different tax periods, so this was affected in different ways. But we expected and predicted, of course, that you would see higher EPS ratings going forward, because the EPS numbers are post-tax numbers. They're after tax. So when we figured on a rough back-of-the-napkin calculation that a typical S&P 500 stock would see about a 9% growth in EPS because of the tax cut. That's their reduction in U.S. portion of their taxes. And most of the S&P 500 are worldwide. They do a lot of business overseas. A lot of their taxes are structured overseas, so it's really not an easy calculation to make. But we figured that you'd see about a 9% EPS growth baked in the cake, not because of business operations, but because of tax code. And now those are remember, EPS these are compared year over year typically. So now they're still in the same taxes, but the delta hasn't changed. Is not the same. So now your EPS change numbers are going to be coming back down. That's built in. You're going to see falling EPS changes going forward because the effect of the tax cut is over. Now, if somehow the next president and Congress come in and rescind the tax cut, you're going to see EPS, of course, year over year fall off a cliff, because you will have higher taxes, which comes right out of the EPS. Anyway, I just wanted to stop there. So now we had our minimum EPS, our earnings growth set at something like 20% in the past, and we've reduced that down to about 15% now. So you want to see something at least about 15% EPS growth. The earnings growth you've seen for 2018 coming into 2019, of course, depending on the fiscal year of the corporation, is over. So now you're going to see the EPS growth come back down to where it was pre-tax cut. Okay, I hope that makes sense. But we had EPS growth bump higher, and now it's coming back down. And if the government rescinds that tax cut, you'll see them drop down even into the single digits, even for strong companies, because the taxes, it's a 40% tax break for corporations for their U.S. operations. It's a big deal. Okay, so back to that. So this VEEV has a 98 composite rating and 2 stock checkup flaws. minus 7.9% funds are leaving these high growth companies. And you've seen that in the past few months. You've seen the Dow maybe even be green, but the Dow be okay, and the NASDAQ won't fall off a cliff. You've seen a lot of the high growth stocks get hammered in here, as many of the mutual funds have been going into safer stocks. Okay, you'll see that the funds are exiting some of these high growth stocks. That's a bit troubling. Okay, Viva. Now we'll go to Copart. Okay, another nice run up here out of this space. You can see we had a sloping trend line way back here, but this had a real nice run up and put in this ugly base. Of course, it's straight up from the bottom and it's a little bit short. And anyway, it's a second stage flat base, a little bit ugly, but it's right here at the buy point. Most of these stocks have terrible patterns. This is one you kind of have to squint to see a decent pattern here, but it's right at the pivot point. The reason why we kept this on here is because you could put a stop right here, perhaps at the bottom of this pink candle, to take an early exit if this were to fail. If you're have a positive outlook going forward on the market, and if you're looking for a high growth stock to be in, this is one a person might consider. It's right at the pivot point off this previous base, and you have an early exit out that you can place on this chart. RS number shows that this stock has done well in a market that has not been performing very well. So this is one to keep on the watch list. 43% earnings growth, 21% sales growth, 99 composite rating, 4.5 stock checkup flaws, a little bit of debt. Again, 8% of the funds have left this. Not good, but that's what they've been doing. They've been going to safer havens. Okay, we'll take a look at earnings on these in a second. IPHI, 96 composite rating, 8 stock checkup flaws, funds of leaving, 122% debt to equity ratio. A little bit high. We've put a little orange marker on that one. But you had a real nice run up, and it is putting in a base. A person could look at this as a double bottom. It's almost a triple bottom, but these are not big shakeouts here. So we're just calling this a consolidation. It's 15% deep. It launched here from the 10-day. It's above the 50. If a person were looking for something, again, if you have a positive outlook of the market and you want to be in a growth stock, you could use perhaps the 50-day as an early exit if the market turns south here. 133% earnings growth, 24% sales growth. Okay, we looked at the other numbers. You've got earnings looking good going forward. And we'll look at earnings plot on this in a second. A little something to be concerned on a couple of these. Okay, KNSL Capital Insurance Group. Okay, had a nice run up, put in a base. It's still in the buy zone here. It's launched from the 21-day, and you've got decent earnings and sales growth. The RS line's telling you that this stock has done well vis-a-vis the general market. As you can see, the market has been terrible lately, and this one is firming up, kind of like a wound spring. So something to look at. It's $15 million daily liquidity. It's okay. A couple of funds have come back in this. The market going forward, the earnings are expected to be good. We'll see that in a second. Proficient. Okay. Not looked at this stock before. Had a base on base on base here. It started to break out and pulled back. Didn't quite fail, but had a pullback. So we've got the alarm set to go off if it were to come back out of this base. Not a really nice base. If you ignore these 2 days around the earnings, it really hasn't based at all. So something to look at. So we're trying to pull diamonds out of the coal in this environment, and this one is one to look at. Not great, but the base on base gets our attention, and it has a nice uptrend. Decent earnings and sales growth. It's only a $10 million daily liquidity. You don't want to be putting too much money into this, but it is something to watch, and it's kind of on our stocks to watch list for the week. It's okay. The next one, Dexcom. Now we own Dexcom. Full disclosure, favorite of ours. It's as users of the product, it's terrific. Okay, it put in a base and pulled, and this is a failure. This tried to break out and failed, and tried to break out and failed. So whether a person wants to consider this base or even going back, if is this a valid base or not, it's up to you. But it is here in the blue zone. This is a bit of a pocket pivot. coming out of here, launching from below the 50 and coming above the 50. Person could use the 50 as a early exit if this were to fail. It has been volatile lately, but we like the company. It's got nice earnings and sales growth. Funds have been leaving DXCM. Has some debt. 6.5 stock checkup flaws. 95 composite rating. Earnings are expected to be good going forward. So let's take a look at these earnings. Let's go back to Viva. Go to the weekly chart so we can see what's going on here, and we'll take a look at the 12 trailing months earnings. So you can see it's done really well, just a little bit of flattening out here in the past couple of quarters. So nothing too bad, but you can see the earnings growth is done well and continue to keep going. Copart, we'll take a look at the 12 trailing months. Again, looks good. Okay, that's healthy. Now IPHI, if you look at the 12 trailing months, you know it's had some trouble in here. Its earnings have fallen off, gone from $1.72 down to 77 cents. Come back up, and you know this might be a little bit hard here, but looks like it's rounding off a bit. So something to be concerned about. But you know that's reflected in the stock price. But it's nothing to have a parade over. This stock is having a little bit of maybe topping here as far as earnings goes. Okay. KNSL. Earnings look pretty good going in the past and going forward. Proficient. Okay, looks great. And DXCM. DXCM looks like it's trying to top. Looks like it's come from -$1 up to 79 cents. Look, that's a projection. Looks like it's starting to top here. But you know this, they make a diabetes monitor, and it's a way for a person not to have to prick their finger a dozen times a day, so you can monitor their blood glucose. People are using these, even non-diabetics are using these to monitor how their body's responding to different foods, or carbohydrate levels and fat levels and so forth. It's a pretty good product, and we like it, and we are investors in that one. But it does look like it's trying to top here on earnings. Okay, and it has been pretty sloppy. This is a bit of a higher risk. Anyway, that's it for this week. Thanks for watching. Remember, nothing you saw should be considered as investment advice. We're not recommending that you buy or sell any of these stocks. You trade at your own peril. It's your own decision, and we are not your investment advisors. And thanks for watching.